As you know, passive income is a big part of my investment portfolio and my journey to financial independence, and in many ways, I think 2026 is the year where the dividend companies will shine. So, in today's video, I'll be taking you through my 5 favorite dividend paying stocks for 2026. I'll show you why I think they hold some good value and exactly how much each of them are paying right now in passive income. But also, as we talk about them, I'll be building my own portfolio with these stocks, and I'll be investing in each of them right now, live and in real time on the video. So, let's get started. Now, before we begin, just remember that I'm not a financial advisor and this is not financial advice. What I share on this channel are my own thoughts and experiences based on my financial journey. The values of investments can go up as well as down, and of course you will need to do your own research before making any decisions. So, last year, we saw some huge growth in the stock market, and this growth centered almost exclusively around the AI industry, so really we're talking about tech and chip companies. From January, we saw a drop of around 17% because of all the tariff wars, and then from that low point, once it subsided, the market climbed an astonishing 38% near the end of the year. Now, I talk about the market as the S&P 500, which is where most people invest, and analysts have estimated that around 75 to 80% of that return was because of companies linked to AI, with the Magnificent Seven accounting for 40% of the total growth themselves, which is frankly unheard of. Now, I could go into more detail, but to make it simple, growth stocks seem overinflated right now, with the Buffett indicator, which values the stock market compared to GDP, being the highest it's ever been in history and showing as strongly overvalued. So, with that said, I still invest in the S&P 500 through good and bad, but for my individual stocks, I'm swaying from the growth stocks I invested in last year to more dividend stocks this year, as we're anticipated to see some more interest rate drops, which can favor some of the companies we'll talk about. Now, with that reasoning, coupled with passive income being part of my financial plan, let's take a look at the stocks that I'll be investing in this year and which dividend stocks are my favorites. The first stock I'll be buying this year is EPR Properties. Now, most of you know that I'm a fan of the property sector, and EPR Properties is a unique player in that space. They're an experiential real estate company, which means instead of offices or shopping malls, they own properties that sell experiences. Think movie theaters, amusement parks, ski resorts, and fitness center. What makes them a great value pick for 2026 is their recovery story. They were hit hard during the pandemic, but they've been making a strong comeback with over 50% share price growth in the last 5 years, and they still haven't made it back to their high point before that. But along with that share price growth, right now EPR is paying a dividend yield of around 7.1%, which is well covered by their earnings. And another perk is they pay their dividends monthly for a second income. The data from Simply Wall Street estimates this stock is trading at 52.8% below its fair value, with earnings estimated to grow at 7.6% a year. Currently, I have £1,460 invested here, and it pays me over £100 a year in passive income. So this is a company I'm going to be adding to during 2026. So, I'm going to go into my investing platform, Trading 212, and today I'm going to top up my holdings and buy more of this stock with another £30 in shares. Next up, we have a true dividend king, PepsiCo. Pepsi isn't just soda, it's a global food and beverage empire. People still buy snacks and drinks regardless of the economy, which makes Pepsi a great defensive stock. Last year marked their 53rd consecutive annual dividend increase, which means they're a dividend aristocrat. Now, in the last few years, Pepsi has had a hard time. It faced tariffs on its soda concentrate from Ireland and 25% on its aluminium under Trump. Its Quaker Foods division faced backlash after a massive recall due to salmonella concerns. And lastly, inflation in the US combined with a more health-conscious population led to decreased demand for snacks as people tried to save money and calories. So if we look at the graph, Pepsi's share price is down from its all-time highs in 2023. Recently, they've shifted some production of concentrate to the US to save tariffs. It's moving production of aluminium cans to plastic composites, and with a reduction in interest rates, there may be more money in people's pockets for snacks. Now, they are not out of the woods. But for me, if I zoom out on this graph, I can see a history of very strong growth over the long term, and I can see this as a potentially good point to invest in a Dividend King. Simply Wall Street lists this as trading at 40% below its estimated value and forecast to grow earnings at 13% a year, and right now, with the lower price, it's paying 3.9% in dividends. So for those reasons, I'm going to go into trading 212 and I'm going to add another £30 to my existing holding of £104 in this stock so I can buy and forget and see where it goes over the long term, like the next 20 years or more, and collect the income. The next stock I'm adding is a global banking giant, HSBC. Headquartered in London, they serve over 40 million customers worldwide. In a world where interest rates are a constant talking point, banks like HSBC are in a strong position to maintain healthy margins. Going into 2026, HSBC is leaning heavily into the digital transformation and the growth of the Asian markets, which analysts expect will drive solid earnings growth. HSBC is currently offering a dividend yield of around 4.2%, which is great for a blue chip financial stock. I like it because it offers a double threat: strong global growth potential coupled with a very reliable payout. Simply Wall Street also has the stock as 28% below its estimated fair value, with earnings forecast to grow at 14% a year. So I'm investing £30 into HSBC right now to add to my existing holdings of £1,100 that have already grown 42%. Next, we have what many call the holy grail of monthly dividends, Realty Income. They own over 15,000 properties globally, leased to high-quality tenants under long-term triple net leases. Realty Income's track record means they've increased their dividend for over 30 consecutive years and have declared over 660 consecutive monthly payouts. Similar to EPR, they struggled since the pandemic and with raised interest rates, which affects their debt payments. If I zoom out, they have spectacular long-term growth and dividends, and with interest rates having come down and looking to decrease more this year, it should benefit their profits. And once again, this could be a good opportunity to buy into a good long-term dividend stock. Currently, they are paying a yield of around 5.7%. Simply Wall Street estimates the stock trading at 41% below its fair value, and earnings are set to grow at 16% a year. Right now, I own £1,600 in the stock and it pays around £90 a year. So I'm going to go into my platform and increase my holdings in the stock by another £30 and let the compounding continue. And lastly, a UK favourite, Aviva. Aviva is one of the largest insurance and retirement businesses in the UK. They have spent the last few years streamlining their business to focus on their strongest markets, and it's paying off. They are a cash-generating powerhouse, and management has been very vocal about returning that excess cash to shareholders, both through dividends and share buybacks. In the last 5 years, their share price has grown by 111%, and so far it's still going. Even with that growth, Simply Wall Street thinks it's still 40% below its estimated fair value, with earnings growth of 18% a year. And right now, Aviva is offering a market-beating dividend of 5.2%. They are operationally very lean, and with a payout ratio that's comfortably sustainable, it's a great pick for a long-term income. I try to diversify my portfolio with some riskier high-growth stocks like AI and tech, and then with some more solid performers over the long term, like the banking and real estate sector. And as you can see, I try and look for companies with undervalued stock prices and a forecast of earnings growth. I invested around £722 in Aviva recently, and it pays around £40 a year. So I'm going to go back into my platform, and for the last stock buy of the day, I'm going to top up my holdings in Aviva with another £30. So there you have it, my 5 favorite dividend stocks for 2026. Now, we never know the future, but my strategy is to invest in solid companies with good fundamentals and track records, then hold them for the long term. But remember to do your own research. By investing in these, I've added a mix of property, finance, insurance, and consumer goods to my portfolio, all while securing a high-yielding, diversified stream of passive income. So if you found this helpful, please remember to like the video and subscribe to follow my journey as I track these stocks throughout the year. If you want to use the same casual cash wealth tracker that I use to monitor my dividends every month, you can find a link in the description below that takes you to our website and explains the whole product and how it works. It's just £6.50 and you can use it every year to track your own path to financial freedom. But until then, I'll see you guys next time, as always, on Casual Cash. Cheers.